Welcome. My name is James Torres, and I'm here with Brian Sweeting. He's one of my college buddies, and he's been in the real estate game for a couple years now. And he's learned a lot in the time, and I am just very gracious that he had time to sit with me and give you guys a lot of knowledge on the concept and title of real estate. So, Brian Sweeting, introduce yourself.
What's up, everybody? My name is Brian Sweeting. Currently, I am the Director of Investments for Frontage Investments. We are a new company, a part of a company that's been around in Augusta, Georgia since the late 1800s. And our primary focus is developing hotels, apartments, HUDs. So we're going to do quite a bit of entire communities, single family houses, apartments, retail, townhomes, and then we have a management company with us as well that will do the day-to-day stuff. I'm excited to be here, excited to share what I've been lucky to learn, and let's get in. Let's get after it.
Awesome, Brian. So great. First off, where did you grow up and what did your parents do for a living?
So I was born in Macon, Georgia, went to elementary school, middle school there, then moved to Augusta, Georgia for high school, and then pretty much have been gone for the past 8 years. I went to Piedmont with the host here, James Torres, played some lacrosse, and then I went to Atlanta and got into the real estate market. As far as my parents are concerned, my dad, aka Storm, is a controller for Kellogg's, which actually just got bought. Kind of wish you would have given me that heads up. Could have made a stock play. My mom is a local elementary school teacher. Both great people, big impact on my life.
Awesome. So, what kind of lessons did you learn from your parents growing up? I know that you actually homeschooled yourself for about a year. Is that right?
Yeah, I was homeschooled for a year when we were moving moving to Augusta from Macon. My mom being a teacher, that was pretty easy. But lessons they taught me would be hard work, take care of the little things. A lot about personal finance. My mom made me take a checkbook writing class. That's paid off greatly since we write so many checks nowadays. And then, be very early to everything. Be early. A lot of very good professional trades, personal stuff as well.
Awesome. So where and when did your passion for real estate really come from?
I got into it pretty accidentally, and I was very fortunate with how I started. Coming out of college, wanted to be a financial advisor, wanted to be in the stock market, believed that was the best way to provide for myself, reach the American dream. Quickly realized it was, pushing product, pushing insurance, things of that nature, and was looking to make a change pretty quick. And got hired into an investor relations role for Acre Realty, which is now has been shuttered, but they hired me to help transition from them being a REIT. They were selling it to another ownership group, and I helped convert shares and work with the people to get all their paperwork and stuff right with the new ownership group. And then from there, I was hired to help raise money on future deals, which we did quite a bit of, apartment developments and retail developments.
If I can ask, how much in that time were you able to raise that you had a hand in?
I'll tell you the most impressive thing we did. We raised $6.5 million in about 40 days. That's probably the most impressive deal we put together, and actually just sold October of 2018 for $33 million, and
wow,
So that was a pretty good return for investors. And that would be under Roberts Properties. They're a great brand.
That's awesome. I mean, what kind of parts did you have in that deal? I mean, to raise that much in 40 days.
I'm sorry, you kind of broke up. What was that? What was your question?
What part or what was your main focus of part of that deal exactly?
Oh, I was hired or in that time frame, I was purely just raising money. So I was out a lot of lunches, a lot of dinners, talking to people, networking, securing those funds. And then I guess from there, whenever we weren't raising money, I was looking for new projects. So, meeting so many new people out raising money, I made a lot of connections and stuff on where the next deal was going to come from. So I got into site selection, market research, getting the insider information about a community, what's about to happen, what's going where. And from there, I kind of really learned the development piece, construction budgeting, construction development of the budget, and then working with banks and to obtain financing.
Wow. That's a lot to learn so quick.
Yeah. Like I said, I was really fortunate. Great brand at Roberts Properties. They do amazing deals, and they do them quick.
Gotcha. So, what steps did you end up taking to learn and understand real estate investments? To the fact that you're able to raise that much money so quick, and of course, your own property and everything.
Well, it's kind of funny. So Roberts Properties, if you're doing a deal, you got to have an offering memorandum, and how we would write them is we would write them so that the most uneducated, ignorant person about real estate investing could actually understand them. So we wrote them in like kindergarten level terms. And from there, I just read so many different OMs from other deals that they had done, from deals I had found online, that really taught me how to structure a deal, how to, what you're looking for in a market, what you're looking for in rents, what you're looking for in return. And I got really blessed with insider information there on the OM side. Besides that, you can self-educate. There's so many sources online now. Bigger Pockets is a really good source for people starting out. Joe Fairless is a good source for people starting out. Bigger Pockets covers every topic. Joe Fairless is in the real estate syndication business, and he does a lot of apartments. I think he's done probably closed on 10,000 units. So he's doing business. And then, you'll graduate, you'll grow, you'll get a lot smarter into the business. And sources like Old Capital, which is a mortgage broker out of Texas, they have a great podcast. And let's see. Adventures in CRE is great for financial real estate modeling in Excel. And then Property Metrics is a good one. For someone like me who's more financial sales, I knew the deals, but I didn't really know how to break it down and explain to people what the returns actually meant. So Property Metrics online is a good source for that.
Awesome. Yeah, personally, since I've been doing digital marketing and going over with restaurant groups and now real estate, going online is where I learned a lot of my stuff. A lot of stuff, dealing with how deals work for real estate agents like yourself and investors and such. It's really neat that digital products are becoming so easy to access, and they're semi-low cost too. And I don't know if you've invested in actual courses where you can take a little 5 chapter course or 5 module course, and it teaches you so much, and it's always in your back pocket if you need.
I did one for Excel, actually, an Excel course.
Yeah, Excel is amazing, dude. You can do so much.
Yeah, shout out Piedmont again. Did not prepare me well for Excel. And probably should step it up there with today's world.
They're working on it slowly. Talking to some of the professors the past few months, they opened up several different majors within, the focus major. So marketing, they have different supply chain, hospitality. Now they've grown a little bit. Now we'll see how that goes for the future, but at least they're making the effort nowadays. But
Yeah.
so kind of what are the different ways a person can get involved in real estate and explain them?
Okay, so yeah, I didn't have the most traditional background starting out in real estate, starting directly in CRE. So most people typically start out flipping homes, buying rental properties. Um, those are probably two easiest direct active ways to start in real estate. And then from there, people usually grow into larger commercial properties, apartments, retail, hospitality,
Mhm.
uh, industrial office kind of things. You could also invest, passively through a REIT, which is just like a stock, but invest directly into real estate properties, and they actually have requirements. And I might be wrong here, but I'm pretty sure they have to give investors back 75% of profits, which is a guarantee versus a stock, which you do not have that guarantee. Um, you could also finance a property. You could be the debt for property, and then you mentioned all the digital stuff. There's places like Fundrise and CrowdStreet that you can invest online, and they'll pick the investments for you. Similar to a REIT, but not quite a REIT. And you can, I know with Fundrise, you can get in with a minimum of $500, which is not usually the case in real estate.
Yeah, I was gonna say that's a lot more bucks, more like 5-figure type of deals, I'm sure.
Yeah. I mean, if your first deal, you should probably expect at least 50,000.
Wow. Okay. So
So,
what were you gonna say?
partnership. You could always partner with somebody if you don't have the whole 50. Find someone.
Yeah, and that's similar kind of what you did, right, with your business partners, right? Kind of they have the network, and you guys kind of fueled your money together and looked for investors, right?
Correct. Yeah. There's three of us.
Awesome. So, someone that's kind of new to owning a property, what should you expect, being a property owner?
If you if you're acquiring a property with tenants, residential or commercial, and so you actually haven't gotten to vet them, you could be facing a lot of nightmares. You didn't, like I said, you didn't have the chance to vet them. You don't know how well they were vetted before they occupied the space, and so you really have no idea what kind of tenants they'll be. You can always get leases and payments and things of that nature to verify your due diligence period, but still, you could be walking into kind of a nightmare situation. So when it comes to dealing with tenants or in-place tenants when acquiring a property, you just got to expect the unexpected. They're gonna complain. They're gonna want a lot of new things, knowing that a new ownership is in place. They're gonna want some of the newer amenities, maybe some painting, some flooring. If you really get like a C or D property, they might need electrical or plumbing or things of that nature, which can get real expensive real fast.
Mm-hmm.
So you got to expect bad things to happen because nothing's perfect. So make sure in your due diligence period you underwrite very conservatively. You don't skimp on your reserves. You need apartments, you need to save $300 a door, retail 15 cents per square foot. Your banker might even have some reserve requirements. Like I know for hotels, it could be 4 or 5% of your income they want you to save. And do not skimp on those. That could really kill you. Then on top of that, have a contingency fund. And then have a plan in place for things to go wrong, especially if you're new to this.
Cool. So I know that you had your property, or you have your property currently, and you're going through the kind of remodel, restructure, or fixing up stage. Have you faced a lot of backlash or a lot of like tension from working on that?
Yeah, our property we're doing right now, we had some structural issues. Sorry, my dog just came up. We had some structural issues and a little bit of electrical nightmare, but that's been resolved. Had a tenant selling a lot of weed out of his place. So we've replaced him, and
Good choice.
yeah. So we don't need the cops there all the time, or other tenants feeling unsafe or not wanting the pot smell in their house, which is
Mhm.
understandable. But so my dog is pawing at me right now. She's being so needy.
Oh.
Um, but yeah, just you gotta. But other than that, no, our property's done really well. We've been able to lease it out fairly quickly, and it's in a good area, so it's
Awesome. Awesome.
seeming like a home run.
So kind of what kind of strategies or systems do you use in valuing a property before you start, working on it? Due diligence, of course.
Due diligence. Well, you gotta read the leases. So the most important thing, I guess, is you'll see the asking price. Sometimes it'll be unlisted. So you got to know what the property is making in its gross income, its expenses, and then what it's netting. And from there, I'm not really in the single family space. I'm mostly in the commercial space. We use cap rates. So a cap rate is really just kind of the risk associated with the property. So like an A property with minimal risk will be 5 to 6% returns. D or C could be 10, 12, 15, 20. It could be really bad. So what you want to do is you find that net income before your debt service, and then you divide, say you have $100,000, it's a 10 cap property, $100,000 divided by 10%, it's $1 million valuation. So that's the primary thing that I use to find the value of a property pretty quick. There's discounted cash flows. You'll get your appraisal. So there's comps also. So there's a variety of different ways, but cap rates the primary source or primary way I do it.
Okay. And I'm sure that since you graduated with a finance degree, I mean, that kind of really helps you so much in understanding those formulas and really getting to the nitty gritty, figuring out what's going on.
Yeah, absolutely. It would have been a lot more challenging to break into real estate without a finance background. Absolutely, yeah.
Definitely. So, I mean, kind of where do you see yourself 3 to 5 years from now, personally and professionally, of course?
Personally, Rachel's gonna love this. I'll probably have two, 3 kids by then, 5 years. No, it's not possible. So 2 kids, maybe on the third. And then professionally, I'd really like to have taken frontage investments and raised at least $50 million via one-off deals, via syndication, and hopefully have closed on a fund. We're looking at doing something here real soon on a fund, and then by 5 years, at least have started on a second fund.
Okay. Awesome. I know you've said syndication several times, and a lot of people don't really know what that means in real estate. Can you kind of explain it real short?
Yeah, absolutely. So syndication is you'll have a sponsor, which is the general partner, and then that individual or that team is doing most of the work. So they have the deal, they have the property or the land, and all the stuff that comes with it, and then they will develop the property or rehab the property, or if it's easy, just go right in and just manage it. But the general partner might not want to have the capital to get the deal done. So what he'll do is he'll go raise the money needed to close on the deal or to develop it or do the rehab. And that the person he raises the money from will be the limited partner in that deal. And it's from a limited party, you are passively investing in the real estate. So you will get, typically you'll see an 8%, 10% preferred return on the deal, some kind of waterfall structure where when they sell, you have, or refinance, the developer or the general partner will have to hit certain return criteria before the general partner makes any money. And usually those deals are split 80-20. So 80% of the cash from the property or deal will go to the limited partner and 20% to the general.
Okay, awesome. Thanks
And that,
for.
yeah, that can be any asset class. I mean, apartments, retail, anything.
Gotcha. Thanks for clearing that up. Not everyone knows that type of jargon and really how it can work a deal.
Mhm.
Syndicators, they can make a ton of money, honestly.
Oh,
From
yeah.
if you syndicate 3 properties a month, I mean you're working hard and you're making a lot of money.
If you syndicate 3 properties a month, I don't know what you're doing. That's insane. I mean, real estate is slow. It's not like stocks. It takes time to close on the land. You're talking about 30, 45, 90-day due diligence periods. So three a month would be insane.
Yeah.
And I guess I can give you. So I'm typically I've only been the general partner in syndications. So I guess I can talk to the limited partner here. When you want to do a passive investment in real estate, specifically through a syndication, you're going to want to look at the fees that the general partner is charging. So a lot of times they'll charge a development fee or a finder's fee. If they have a construction company, they'll charge a construction fee, and then from there they could charge due diligence fees. I mean, there's a whole list of things that they could charge you. But typically, you're not going to want to pay more than 3 to 6% in upfront fees, and then a lot of times on an ongoing annual basis, they'll charge a 1% to 1.5% to manage that money that you've given them. And a lot of times those minimum investments are 25 or 50,000. Some go as high as 500,000. And so that ongoing fee will be based on the money that was raised for the deal.
Wow. Damn. That's so interesting. Like just
Yeah.
understanding.
Yeah. I mean,
All right. So I'm kind of explaining why you chose the property or the current property that you have as your first one. I know that you're looking at multiple properties over the past few years, and you landed on this one.
this one was interesting for a lot of different reasons, but we kind of had monitored it for a while, and we saw really where we could get in and increase the value of the property. And it kind of worked out well that the owner needed to sell. So we were able to get a really good offer in. So and they accepted it fairly quickly. There wasn't much negotiation. They needed to move the property, and we had been talking with banks for a while. Trying to get a good feel of what the terms of the loan would be and really what it would appraise at. And we closed and then we had it appraised before we closed, obviously, and we doubled our money. The appraisal doubled our purchase price. So we got a on paper return very, very quickly.
Awesome.
Yeah. With still an additional way to add more value in the future. So it was a long time coming for that particular property. It had the owner, I think, lived in Virginia. So it was just a lot easier for us to manage it and really improve that bottom line.
Amazing. That's awesome. So kind of wrap up here, but what are the top 3 books you recommend for someone looking to start a career in real estate?
I read a lot, and I would say my foundation was not necessarily formed in real estate. So I believe that stocks were the best way to make money, and they're a great way to provide additional income or additional appreciation to your overall portfolio. So I started out reading a lot of Warren Buffett books, different business books to really form my understanding of investing and business and things to look for. So I guess the Wall Street Journal, the complete real estate investing book, would probably be my best real estate investing book. And then I think um, How to Win Friends and Influence People by Dale Carnegie. So that's not a real estate book, but it's all about relationships. And real estate is 100% relation relationship driven, and the fact that you got to have brokers that want to work with you, or real estate agents that want to work with you, or you got to have mortgage people that trust you and want to finance your properties, and then you need to have good relationships with local people in the area to know what's going on, and also to raise money from if you need to. So How to Win Friends is so important on building relationships. And then another book I really like is Built to Last, and then the sequel, Good to Great, by Jim Collins. And he talks a lot about businesses that differentiated themselves from the rest, from their competitors. And a lot of people do real estate as a hobby. They see HGTV and they think, oh, I can just go do that. And that's not really the case. You want it to be a business. So I think it's important to have a good business understanding and how to operate a business, how to keep costs low, how to drive income up. Mm-hmm. So that book, books Built to Last, Good to Great, give you a lot of examples, real life examples of how to sustain your business and then make it something special.
Awesome. That's amazing. Being a person or not quite similar to you, but I started reading about a year and a half ago, close to 2 years now, and you've done it ever since we were in college, really. Before that, really.
Oh yeah, that would be another thing my parents did. They made me read so much.
Yeah. It's worked out. It's paid a lot of dividends to you right now.
Yeah, Warren Buffett says like the greatest investment you can make is in yourself. So I'm totally on board with that. Spend your money on books.
I do have to ask, when it comes to Warren Buffett, what's your favorite documentary on him?
Documentary? I've only seen the HBO one, and it was really well done. It goes into more of his personal life than his business life. But yeah, I probably have 4 or 5 books on him right now that I was reading throughout college and stuff. So I'll go get a book on him before I would watch the documentary.
Gotcha. Okay.
I mean, he's crazy. He's a crazy guy. I would love to go to Omaha one day for his stockholders meeting.
Hey, it's gonna happen sometime soon. Put it in the universe, and it will come to you.
He's old. It's gonna have to happen real soon.
Hey, 3 to 5 years, you could do it, I'm sure. And he's got some time on him on a little. Yeah. But kind of a bonus question. So I know you said a lot of people, start their real estate career flipping homes and, doing some income properties, but which one do you prefer to do, and which would you advise to do first, and why?
I was in high school during the Great Recession from 2007 to 2012-ish. And so I saw a lot of flipping go bad. I saw a lot of people lose a lot of money, lose a lot of their personal net worth. And Jamie Dimon, the CEO of JP Morgan, said something really interesting this week when he was testifying in Congress. He was talking about cryptocurrencies, but if I remember him correctly, he said, cryptocurrencies don't have a real underlying value. They're only worth what the next person will pay for them. So that kind of applies to single family houses as well. If you go buy a house for your family, you're not looking at income. It's just what can you pay, and what do the houses next to it say it's worth. Real estate agents can pull comps, can get an appraisal from the bank, but that's still coming from comps. So I would suggest starting out in rentals. I know a lot of people like the flips because of the immediate returns, but if you don't know what you're doing, you could just utterly bankrupt yourself. And especially if you don't have a contract or a construction or contractor background, you don't know what you're looking for, and it could take a lot longer than you think it might take. And I personally do not really invest at all based on appreciation. I'm really solely looking at the cash flow. I want to know expenses. I want to know gross income. I want to know net. I want to know what market rates are for rentals and per square foot rates in retail and office space. Um, um, and
What up, dog?
um, so rental properties is where I would suggest starting. You can get a little bit of income, or you can just save it and use it towards your next property. But again, I understand the attractiveness of flipping a home, how quick that money seems to come for us. I purely, so I guess if you know where a market mover is, like a hospital or school or new development, anything like that, that could substantially increase the value of a property, I would look at an appreciation value there or a flip there. But really, I'm 95% of the time just investing based on current income. And it's important. You wanna offer a price based on the current income, not potential or gross.
Okay, awesome. Yeah, that's kind of the end of my questions. Do you have anything for me that you want to, promote yourself or, um, you know, do a shout out to anyone?
Shout out Piedmont. Um,
Let's go Lions.
oh yes, yeah. Go enroll at Piedmont College. I will be doing a lecture in the fall in real estate. So sign up for the real estate courses there offered by Margaret Ryder, I think. And you will get a head start on me because I didn't know anything about real estate till professional world, real life.
Mm-hmm. Yeah, that's awesome. I'm glad that I was able to connect you with Margaret again and, put you on that path of ultimately teaching and educating people on how to properly, use their finances towards real estate and wiggle themselves into a good position for themselves in the future. But
I would say wiggle strategically.
yeah, I mean, sometimes you gotta zig, sometimes you gotta zag, and sometimes there's a big wall that you gotta jump over. So you gotta figure it out.
Oh, that's another good book. The Obstacle is the Way. That's another good book.
The Obstacle is the Way. Who's that one by?
Uh, he wrote another one called Ego is the Enemy too, and that's a good one.
Okay, awesome. I took notes of several of the things you said, so it's going to be really cool having this posted on Facebook so that a lot of people that I started gravitating to and started networking with can take some food for thought from you. If they have any other sayings, they can just let me know. And of course, I'm excited to start this journey of interviewing people in the real estate network and get myself up there. I want to be very happy with all this in the next 2-3 years. So I appreciate you, Brian, for being on here for the first time and being my first guest.
Yeah, man, I'm honored. I'm excited. I'm glad we got to do it. I wish you all the best of luck, and hopefully this blows up for you so you can get that marketing grind really to take off.
Yes, sir. I appreciate it, Brian. Well, if you do well, tell Rachel I said, hey, I don't know what else. I was going to say, pet the dogs for me. I haven't seen them in like 3 years, I swear.
Yeah, dude, they're big. They're big now. Awesome. I'm excited. Growth is great. All right, buddy. Take it easy.
Cheers, Tony.